Good morning to everyone. I'm going to switch to English because we have Pat in the panel. I'm Paula Jiménez. I'm the IST leader that's in Source Solutions for Tax partner in Mexico City. And we're going to be discussing some, practical considerations regarding the U.S. tax reform. I think you've all heard before from our colleagues that this reform includes fundamental changes to the way multinationals are taxed going forward. And just to name a few, I think just the shift from a worldwide tax regime to a hybrid territorial regime, it's a big change. The new minimum tax to low tax earnings, or certain provisions that Lisette and Fernando were talking about, and you were talking about before, about preventing base erosion and trying to promote U.S. production, just to name a few, will have a lot of impact in international taxation. And again, I think the purpose of this panel is just have a clear overview of the toll charge, which you may have heard as a repatriation charge. And that's what Pat is going to be discussing first. And then I'm going to try to give you guys some considerations that we all should have in mind as tax practitioners or finance executives in Mexican subsidiaries of U.S. multinationals. So without, I think, further introduction, Pat, if you want to start.
Sure, thanks. So I think we'll spend just a little bit of time getting into a little bit more granular the toll charge. And if you recall, I earlier mentioned that the toll charge was the price to pay for the U.S. to adopt a territorial type regime where we get the DRD. It was very, very expensive. The way that the law was passed in the U.S. was under our budget reconciliation, so we were limited to a prescribed amount of debt that we could add to the national debt. That was $1.5 trillion, the way that it was decided and communicated. The toll charge is the mechanism to recoup back about $1 billion. It's not that much. It's a very, very large number. You will see when the financial statements are released from some of the very large companies in the next coming weeks, and we're starting to see it now, there will be very large tax provisions in the adoption. Long term, they'll be very favorably impacted. Tax rates will go down. But for the year of adoption, because of the toll charge and because of revaluing deferred tax assets from a 35 to a 21% rate, you're going to see a lot of movement in financial rate. Well, let's talk about the toll charge, because I expect you will hear a lot about this, because the American companies who have a Mexican investment will need your help, okay? Previously said that it's a tax on all unremitted earnings measured from a U.S. tax principle, okay, what we call earnings and profits, generated from 1986 for what we also call, it's a new term, specified foreign corporations. A specified foreign corporation, let's just for today say a 10% owned company. So it can be either a controlled foreign corporation, these 50%, or it gets all the way down to a 10% owned company. Those U.S. shareholders then have to pick up their pro rata share of the unremitted earnings and profits. The E&P, if I could just use that term for a minute, has two different measurement dates, and it's the higher of. So a U.S. shareholder has to include their pro rata share of the specified foreign corporations post-86 unremitted earnings and profits as of either November 2nd, which was the date that the House originally registered their act. It wasn't published until the 4th, but November 2nd, or 12/31. Now, there's a lot of complexities about what happens between payments between specified foreign corporations and how they're eliminated so you don't get a double counting. For example, let's say you define your E&P at November 2nd for one company, but it pays a intercompany charge, interest, let's say, to another specified foreign corporation, thereby increasing that other specified foreign corporation's E&P at 1231. Well, we don't want to double count that, okay? So I mentioned earlier the complexities. That's one area of complexities. Another relates to deficits. The rule is that we're picking up the net undistributed earnings and profits as of these dates. If a taxpayer, a specified foreign corporation, has a net deficit measured as of November 2nd only, the rule does not extend to deficits at 12/31. I don't know why. It just doesn't. So only deficits existing at November 2nd can offset the positive E&P of the unremitted earnings from the other positive aggregate foreign corporations. Okay? And there are special rules on how you allocate that deficit, how you portion it. It's measured up at the U.S. shareholder level and then done pro rata based on the positive members. It has a huge difference on how this E&P is allocated, because any E&P that's allocated to a positive member means foreign tax credits are unutilized. They get trapped because of the mechanism on how we compute foreign tax credits that can come up and offset some of this toll charge. So if a company has $100 of positive unremitted earnings and profits and has, some taxes associated with that, okay? Let's say 20. If they were to distribute all of that in a deemed charge, they could bring up $20 of that, and that is reduced pro rata, the $20 of tax credits, pro rata based upon whether or not it's either an 8 or a 15.5% tax rate. But you get the credits for your relative pickup. Now, if you have a deficit, and that offsets that 100 down to, say, 66%, then you have an immediate loss of 1/3 of those foreign tax credits before you then apply the further reduction for the pro rata pickup based upon the relative percentage, if it's an 8 or 15.5% tax vis-a-vis the 35. I mentioned complexities. Don't need to spend a ton of time into it, but that's some of the stuff up in the States that we're dealing with that I'm sure you guys will be hearing about, because we need your help in computing a lot of these calculations. I talked about the 15.5%. That's on the earnings that have been reinvested in cash and cash equivalents. That's a technical term. It's a defined term. It basically means cash, net accounts receivables offset by account payables, other things that will turn in 1 year. Okay? So the aggregate of those things. Now here's the tricky part. Congress didn't do us any favors. This probably will require some more of your help, so I want to mention it to you. That cash equivalent has to be at the higher of December 31, 2017, or the average amount of the cash balance at December 31, 16 and 15 for calendar year taxpayers. So of the prior 2 years. So it is very possible that you'll get questions about your financial statements, your trial balance. Try to measure what is a cash and cash equivalent and getting into some of the granularities, okay?
Just one question there, Pat. Is there a reason why to have this alternative dates, the higher off? Is it because they're just foreseeing that some taxpayers did some planning to lower the cash balance, at the end of 2017, or?
Absolutely.
Yep.
I did. We did a lot of planning because we knew that this law was coming. A lot of our clients tried to pay dividends. And here's another big change. We paid huge dividends, hyping foreign tax credits during the last couple of years, okay? Those dividends that were paid in 2017, not prior to 2017, have to actually get added back and don't get on our U.S. tax return, okay? So if a company paid a dividend in April, well before this was enacted, that is not a dividend for U.S. income tax purposes in 2017, and we're going to ignore it. What instead is you have to compute it under the toll charge, so that E&P gets added back. A lot of companies were rearranging their balance sheet in order to get cash off the foreign subsidiaries' books and records so that we weren't taxed at what ended up being a 15.5, but rather than the 8. And I'm not talking small numbers. We're talking billions and billions and billions of dollars. Some of the largest companies in America were doing this. Treasury isn't, I was going to say Treasury isn't stupid, but often they are. They knew that we were doing these things.
Right.
Okay, a lot of people went to the government from private sector, and they wrote the law in order to capture all this prior tax planning.
So
Okay.
really, unless the taxpayer had a crystal ball that could prevent this from happening 3 years ago, it's as if nothing had happened in terms of planning. They'll still capture that cash into the toll charge calculation.
Yeah, and it's very hard. They absolutely did. The rules were written to give a level playing field for people who didn't do the planning,
Right.
and who were just running their business operations. So it's actually fair, but it's very rare that you see this kind of law with this many provisions to prevent tax planning that was known by the government.
Right. In just, I mean, before we start into the practical considerations, I guess it's worth mentioning that probably this new repatriation tax is going to have some effects in the financial statements because, you know, U.S. multinationals will have to adjust their DTAs, DTLs, book the reserve, and we're setting a lot of headlines and within the, you know, U.S. Papers with respect to hits being taken by U.S. taxpayers because of the reform. Is that, I mean,
Yeah, I can tell you, we are very, very, very busy right now up in the U.S. because we have to recompute all the deferred tax assets and deferred tax liabilities on the U.S. balance sheet, including those from the foreign subsidiaries deemed coming back to the U.S. for the reduced rate from 35 to 21 with states. And now the states also, because of the way states are enacted, not all states automatically adopt federal law. So now, in addition to the federal changes in looking at the deferred tax assets and deferred tax liabilities, we've got to figure out what states are adopting, what provisions they're adopting and moving. And the U.S. is also, in financial statements, we used to call it APB 23, which was an assumption or representation management could make that they would permanently reinvest their foreign earnings so that they didn't have to book in the financial statements a tax cost as though they had remitted the earnings, even if they didn't do the cash. Well, that's changed now because of the Job Act. So there's a whole lot of time. You're going to see a lot of financial statement impact.
yeah. I mean, just looking at the papers nowadays, you'll see a headline of, you know, big multinationals taking additional hits, right? So moving on to the practical issues, I think you're questioning why we go into this level of detail on the toll charge and the E&P. And I think that's because precisely it's going to, you know, take some time from our day-to-day activities because of the help our U.S. colleagues will need from us, just helping figure out what the balances are, what's the backup information that will be required, so on and so forth. So probably it's worth just taking a step back and understanding what E&P is. Generally speaking, I'm of course not an expert on what that is and how it's calculated. That's why Pat is here. But so E&P, as he said, stands for earnings and profits, and it represents precisely, you know, the economic earnings and losses of a foreign corporation that can be distributed up to the U.S. shareholder in the form of a dividend. So it's something similar to what we have as COFIN in Mexico, and it kind of has the same, you know, the same purpose. It follows the same purpose, but it's not as easy as looking at the P&L and just looking at the retained earnings row and thinking, well, that's the base for the repatriation charge, because that's not true. I think it's much more complex than that. And the way I would probably summarize it, or the way I understood it, was it's really like a three-step approach, right? The first would be just having our local statutory P&L, estado de resultados. Then just making all the relevant adjustments to convert it to a US GAAP P&L, right? And many of us, well, not me, but many of in this room are familiar with, the complexity of those adjustments. And then I think there's a misconception that E&P is equivalent to US GAAP retained earnings, which it's probably, a proxy to estimate the E&P, but it's really not, the same amount and the same balance. And there are further adjustments required. I can think probably, permanent and temporary differences, or the ways, certain transactions are booked for US GAAP purposes, whereas, for E&P purposes would have a different booking, so on and so forth. So I do not intend to walk you through each and every adjustment, because I just don't know that. But I guess what we want to do here is just let you be aware that we'll likely be asked from our US colleagues to have all this information available, and just, walking them through all these adjustments from the local P&L to the US GAAP P&L to the E&P, so that they can have their balances ready for computing and booking the repatriation charge.
And this information, this earnings and profits, is supposed to be computed every year by the U.S. taxpayer, and actually supposed to be reported to the IRS. It's on a form called 5471, but the vast majority of companies take a swag at this number, because it's only for, historically, informational reporting purposes, and they would true it up when they were paying a dividend when it would enter into our foreign tax credit calculation. So a lot of the companies are scrambling now, because whereas they might have reported maybe local country income adjusted for GAAP, they most likely did not make what we call earnings and profits adjustments. And why don't we just maybe tick off a couple of those to kind of give a semblance of what that work might be. So E&P is an economic concept. It's designed to mirror U.S. taxes. So once you get your statutory pulled into changes for U.S. GAAP, then you're supposed to make changes to appear to economic reality in the eyes of a U.S. taxpayer, okay? So you'd have to recompute depreciation to U.S. standards of depreciation under our, what we call our ADS, which is our straight line rate. You would have to reverse accruals that were not paid or functionally recognized within a certain period of time. You could not do bad debt deductions unless they were realized and written off. Things like vacation accruals not paid in 8.5 months. There's, a list that really gets into the calculations. Now, interestingly, the term is not defined. There is no definition of E&P in U.S. tax law. There's merely a listing of things that you have to change, and that's not even true. There's just things that you have to change in order to comply to get it to a U.S. standard. But it's an economic reality. For example, penalties. Penalties may not be deducted for U.S. tax purposes. Same with meals and entertainment. We used to have a 50% deduction. Now under the Tax Act, 100% of meals and entertainment are non-deductible for U.S. purposes. But they are for E&P purposes, because it's an economic reality. You actually paid for that meal. You actually had cash leave the company. So that would be another E&P adjustment.
Right. So again, and thanks. I think that's going to add another layer of complexity to our daily jobs here in Mexico, because we'll need to have all this information first available for U.S. colleagues to have the computation. We'll likely be asked to walk them through the adjustments and help them do calculations, right? So this is something that I expect that will be happening in the following 6 to 8 months of this year.
Well, to true up. So let's.
The true up, that's
Yeah,
right.
people are going to try to do a best estimate for financial reporting, but come tax return purposes, they're going to have to get the right numbers. So not only the E&P, but if you have time now, go get your tax returns. Go get every single tax return you can get your hands on since 1986, including companies that were acquired, merged, anything that that E&P would relate to, you're going to be asked to prove the tax returns.
Right, right, and there's a specific bullet in the following slide. So one other important concept that I think it's worth having in our top of our minds is this repatriation tax or toll charge as triggered as if a dividend was distributed by the foreign subsidiaries up to the U.S. shareholder. And what does that mean by deemed? That means that there doesn't need to be an actual cash distribution, or from a Mexican standpoint, there does not need to be a dividend payment up to the U.S. or a capital redemption out of Mexico for the tax to become due and payable, right? So we just need to have that in mind, because I've seen some misconceptions around, well, I don't have retained earnings in Mexico that would allow me to make a dividend distribution, or I don't have enough, CUCA that would allow for a capital redemption. Well, it doesn't matter. This tax is going to be triggered regardless of the fact the cash or any distribution is actually made.
We are not looking at local statutory capabilities to pay the dividends,
Right.
not the CUCA accounts.
Exactly.
Which may or may not be fair, okay? We're looking at it from solely a U.S. principal purpose and saying, did you have unremitted earnings that should be taxed in the U.S.? And that's the standard, so.
Yeah. And I think we already discussed, how that is computed. Yeah, go ahead.
Sorry, I have a question about the earnings and profits. Just as you were talking about concepts that are included to reduce EMP, a question I have is about what happens with tax payments that are made, let's say now, like through audits, that relate to prior years. Does that, how does that affect, because you talked about the cutoff dates, but, so maybe can you speak a little to that?
Yeah.
Would that, is there any benefit, let's say, to settling audits, like in this time period?
Yeah, well, thanks for asking an easy question. Yeah, thanks. Let me take it in two parts, okay? Let's talk about taxes. We had a November 2nd cutoff date for E&P, okay? Let's assume it's a calendar year taxpayer, so it's got a 12/31 year end, which is very typical down here in Mexico, right? But our cutoff date might have been November 2nd because it's the higher of the E&P at November 2nd or 12/31. Well, one of the things that might have made the E&P higher at November 2nd is the taxes. The tax on a Mexican company does not become fixed and determinable until the end of the year at 12/31. It is not an E&P deduction in my 11/2 E&P calculation, but it is in my 12/31 E&P calculation. So if a company does no further activity after November 2nd, and it was profitable as of November 2nd, by definition, their E&P at November 2nd will be higher than their E&P at 12/31, and that's not the only bad news. The taxes aren't creditable for the current year. Because that amount, you're picking the E&P up at November 2nd, because the taxes in the current year weren't fixed and determinable, they're not credible vis-a-vis the E&P at November 2nd. Okay? Mentioned complexities when I was visiting with David in the very first session. That's one of them. It was unintended. Okay? It's been raised in requesting advice from our Treasury, but we haven't received any, and I don't think any is forthcoming on that. Now, you asked another comment. Let's say we have audits going on. Hacienda is, can, maybe resolve an audit quickly, so that you figure whether or not you could include that tax payment that relates to a prior year, but paid or accrued after 12/31. The answer is it's not certain whether or not that will be able to be claimed as a credit. Okay?
Yeah.
I think it should be creditable, okay? It depends on how you booked it. If it's paid after 12/31, there are rules that talk about if it was paid within the 2 years after accrual. I would not be surprised at all if that amount were not creditable. And it is not an E&P adjustment. Question is whether or not it's creditable.
Right.
I beg your pardon?
It's not an EMP adjustment? And again, just thinking, so if I have an open audit, let's say for 2016,
Yeah.
is there any incentive for me to close it out
Well,
before the toll charge?
And it's not 100% resolved. I would say if you booked it as a tax expense, okay, it's an E&P reduction. E&P is an after-tax concept. So you would have booked that amount as a deduction in computing your regular E&P. I would take that deduction every day in computing my E&P. I think that there's very, very strong arguments that you should be able to claim the credit because it relates to that E&P within that post-86 basket. There are different positions that is not 100% certainty, though.
And when would it have to be closed out? What's the end, kind of the drop dead date for that?
There isn't one.
You could always file an amended return?
No, I don't think, well, I don't know the actual answer, okay? If you resolve the audit in 19 and 20, there's certain rules about a 2-year period after a return has been filed under 905C adjustments, whether or not you just pick it up as a carry forward in your foreign tax credits or your permissibility to go back. There's a 2-year assumption of being able to go back and make changes. But we've never had a system before where credits weren't important and we had such a locked date dead on 12/31 on deemed credits. It's a great question. It's not totally resolved, but I could tell you what most people would do. They would match it up with the E&P. Yeah, Mark.
Right.
Tagging along on the Seth's question, then, the key though is if November 2nd, that number is higher.
Yep.
And obviously by including that for 12/31, it's going to make the E&P lower. The likelihood of you being able to use that as a benefit is probably low.
That's right. So Mark's point was if the measurement date on an E&P is November 2nd, we aren't going to get current year credits on that no matter what the adjustment is. The way the rule is written, until there's clarification, 2017 taxes are not able to be used as a deduct to lower the E&P or as a credit in the foreign tax credit calculation as part of toll charge on the 2017 E&P amount. Now, there could be clarifications on that coming years or in coming weeks. We, through some inside sources, have been led to believe that there is going to be a notice, which is a clarification on how to implement certain rules from the Treasury and the IRS. It's supposed to be due, it's through already the international section of the IRS. It's going through its quality control review. It could come out Friday. That was their due date. Often it's late. So this could be very one of those clarifications that come out in soon time. Yeah, Mark.
Following that up, if the deduction is from a prior year's audit, you would still be able to use that as November 2nd then, wouldn't you?
So the question is, if an audit relates to prior years, let's say 2015, would you be able to deduct that against the E&P in prior years?
On November 2nd.
For November 2nd. I would think the answer would be yes, okay? But I am not 100% certain on the credibility of it since it wasn't paid within that period of time. I don't know the answer.
So just moving a bit, and real quick, we have like 3 minutes left. Just moving away a bit about, from toll charge, other considerations that this reform may have in Mexico that we need to think about is first the repeal of the U.S. tax deferral system, right? And what that may affect in cash pooling structure. So currently, it's common to see a cash pool header abroad outside from the U.S. where the Mexican subsidiaries would send usually their excess cash that would be redeployed globally as opposed to sending it back to the U.S. because of the taxing at 35% rate. Nowadays, when the tax rate is 21%, then I don't think there'll be a need to keep cash offshore from the U.S. And I think that brings an opportunity on how to think about settling all intercompany receivables with the cash pool header in the most efficient tax manner.
Right. It's not only the lowering the tax rate, it's because of our dividend received deduction. Absent any dividend withholding tax, if we don't own 80% of the companies, it really is removed the federal tax barrier from paying dividends from Mexico up to the U.S. So I would imagine treasurers who have always been told they can't bring cash back by the tax department aren't going to hear that anymore. So there will be a higher need for or demand of that cash tax coming up. So header accounts, pooling accounts, they're going to get changed. We still cannot lend money from Mexican to a U.S. company. There is another subpart F provision that still was retained, so that's not permissible. But another structure I know that we had a discussion on earlier that I'd like to mention is branches.
Right.
And
So
maquilas.
there may be an interest in just shifting from a branch structure to a CFC structure, right?
Yeah, there very well could be. So branches do not receive the same federal or beneficial taxation of dividends or branch remittances not being subject to U.S. tax. They're still flow-through entities for U.S. purposes. So you could see changes in supply chain as well as maybe incorporation of some of that. You need to run the models. There are some pluses and minuses, but if you're in a branch structure, you should look at it.
And Ben, just one question around that change. Would that be as simple as, checking the box, or that could imply, I know there's a 5-year, limitation about the check the box and so on and so forth, but that could also imply just, changing the form of a Mexican subsidiary from an SRL, which is available to be checked as disregarded, to a corporation per se. And
that's how they might affect the change, but an outbound transfer like that is a taxable event for U.S. purposes. And they've eliminated one of the abilities to do that tax-free from a active trade or business exception. And there are some reasons why you might want to be a branch, like our FDII and things of that nature that we talked about earlier. But why don't we leave it as a final thought? If you are a branch structure of the U.S. company, why don't you call one of these folks here, and it is worth that discussion because the tax of a branch is significantly different than the U.S. taxation of a Mexican company. Better, worse, depends on your facts.
Right. So I think we're on time. Thank you, Pat. First of all, thank you, everyone, for the attention. I think we're heading to a break, a 20-minute break, and then we'll come back, right? Okay, thanks.